Hi, guys, and welcome to my channel. This is your girl Megan with Fit Financial Planning, working out your own financial plan one lesson at a time. Thank you so much for joining me for our second installment as we analyze what a risk quote actually looks like. In my previous video, we looked at, if you haven't watched it, please go ahead and watch it. We looked at the benefits and we looked at how a quote is actually constructed, and we looked at what are the details do they take into account when quoting. And then we looked at the benefits. To recap, the benefits that I quoted were the death benefit, which is a whole of life benefit, life cover, comprehensive disability plus, which is a standalone, and then comprehensive severe illness plus, all right, which is also standalone. And this is a whole of life policy. Remember, disability ceases at the age of 65, so it is a term product, all right. And then we looked through what is included automatically in the comprehensive disability plus, and this is where I ended in the previous video, all right. So we're going to pick up from here. As we continue, we just need to see here that one thing I want to remind you is that remember, you need to understand every aspect of a quote, okay? Because a lot of this information will be available in your contract. Once you have taken up the policy, you get a policy schedule, and then you get a policy contract. In some cases, it's all one document, and then you get all this fine print. But how many people actually read the contract? How many people actually read what this cover is all about and how this cover actually works? But that's why I'm giving us an opportunity to go through the quote, because remember, yesterday I mentioned in the very beginning, let's just go all the way back. All right. Should you take up any quote, all right, with a financial advisor, this is their first statement. Okay. It says, this is a quotation for a possible contract between you, the applicant, and us, Sanlam Life Limited. All right. So basically, your quote is your contract. It's a possible contract. So that's why they put all this information here, because they basically translate all this information into your actual contract, which they will send to you and you need to keep on file. All right. So by signing this contract, you're already agreeing with the terms and conditions that they've specified on this contract. Okay. And this is what I want to break down for you. Okay. So let's continue. So in our last video, this is where we ended with the total risk premium. Okay, basically the asterisk here just means that cover for this benefit ends at death in case of whole of life benefits, and when we go up, that's got an asterisk meaning at death, which is whole of life. Okay, as well as your life cover. So your risk classification, like, right, lives insured are classified in rating categories. Okay, so this is how your risk is identified, or this is how they are able to identify you as an individual. Okay, and for everybody, this will be different. Okay, so that's why you have different premiums for specific things because of the categories, okay, because of what they take into account. First of all, they will take your gender into account. They'll take your smoker status, your qualifications and income, and in the case of death benefits, your body mass index. Okay, these rating factors are statistically proven to be correlated with the ultimate claims outcome, and as such are applied regardless of the life assured state of health. Right, so it doesn't matter whether you do cross country, you are triathlon, but if you smoke, you are at a lower risk, you're at a higher risk basically of developing any type of lung cancer or cancer in your body, because we know the effects of smoking. So it doesn't matter whether you are healthy, but if you're a smoker, that's a red flag. All right. But also your qualifications, your income, your body mass index. All right. It doesn't matter whether you are, an Iron Man type of person that is bulky and built. But if your BMI is higher than 30, then you will definitely get a loading. It doesn't matter whether you're a bodybuilder and you are fit and you eat raw eggs and XYZ and you look like, an Iron Man. if your body mass index is higher, so remember your body mass index, your BMI, they take into account your height and your weight. And there's a calculation that they do to establish how heavy you are, regardless of whether it's pure muscle or you got fat. Okay, if your BMI indicates X, then they will load you. So this is basically what this says, this section here. Okay, because I think you might feel that maybe you're being discriminated against because that you're a bodybuilder and you are heavier, but you are quite short as well. So your mass multiplied by your height gives you a specific BMI, and most times it will be higher than 30, regardless of whether they've taken your body fat into account, the amount of water you have in your body, or your bone density. They don't look at things like that, all right? So this just says that all rating factors, including raised body mass, are also applied when options are exercised to purchase cover without proof of good health. Payment adjustments for raised body mass as a rating factor depend on the rate group, smoker status, and qualifications, and may be up to 25% of the benefit payment of the death benefits. For this quotation, the maximum benefit payments for the life assured should his or her body mass index be 30 or higher, inclusive of other loadings if applied, are as follows. So basically, they're just giving you an example on how much you will pay at, for this specific cover should they add a loading. All right. Remember, the initial life cover premium for this amount before medicals are done is 174 Rand. Okay. Now, let's say if they apply a loading at a maximum of 25%, then your new premium will be 217 Rand. Okay, so this will only be established once your medicals are done and once the underwriting has assessed your application. And they're just pointing out that, listen, this might be applicable to you, and this is why. Okay, so if your BMI and everything is normal, is standard, then they'll grant you your benefits at standard rates. However, if they pick up that, listen, once we've done all our checks, you filled out the form, and this is what we've established, they will then add a loading, and then this will be your new premium. So it becomes more expensive. Okay. So here they touch on underwriting. The granting of benefits or the final monthly payment for benefits may further be subject to any additional underwriting requirements that may be required. We do underwriting for a variety of health and lifestyle factors, including raised body mass, medical history, occupation, and part-time activities. Should the monthly payment of a benefit be adjusted because of the limitation of the cover amount, the verification of the BMI as a rating factor, the final underwriting terms, and the total payment of the plan, the illustrative amount of monthly payments and the commissions may be adjusted accordingly. Okay, so basically they say these illustrative amounts are at normal rates. Okay, so basically remember giving us a 10-year guarantee. So this shows you how much your benefits. Remember, the option that I chose is 5% of my benefit increases per year, as well as 5% of my premium will increase by 5% per year, meaning that the first 10 years is guaranteed. And this is how much cover I will have in 10 years' time with the 5% increase. But here they're saying, however, should there be these amounts will be adjusted should they find that any of these conditions need to be adjusted after underwriting, then they will adjust these illustrative, amounts accordingly. But note, let's say they give you a loading because of BMI or whatever the case may be. Note that your cover amount doesn't go up, only your premium goes up. So you're basically paying more for the same cover because you're at a higher risk, and that's based on the results from underwriting. Okay, so that's basically giving you an illustrative amount and then also illustrative amount of the payment patterns. Okay, and this is, remember this, the payment pattern I chose was level, which means that we're level at 5%, which means that every year the premium will increase by 5%. Okay, and this is how it will increase, and the first 10 years is guaranteed. So I know that in 10 years time I'll be paying XYZ for the specific cover that I have. Okay. Okay, so here this is basically initial additional information. So basically, these illustrative amounts have been calculated on the assumption that the yearly increase as described under benefit growth and payment growth will take place. That is that 5% compulsory. All payment amounts illustrated after the 10-year period are based on our current estimates. Okay, so anything after 10 years is just based on current estimates. However, this whole section here just says that after 10 years or after your guaranteed period ends, we are going to assess whether, taking into account the claims trajectories, the history, the patterns of claims, what is happening, in the world in terms of health, medical improvements, in terms of any, like the pandemic, for instance. A lot of insurance companies increase their rates because of the high mortality rate and because of the high claim rate. So they had to increase and readjust their benefits and readjust the premiums. Okay, because at the end of the day, the insurance company is going to go bankrupt if it cannot maintain or pay out these claims. So in certain instances, so specifically for this policy, after 10 years, they will reassess to say, is this cover still in line with the premium they are paying, or do we need to adjust the premium a little bit so that it can accommodate us, and we are able to actually pay out this claim when the time comes. So that's basically what this all says. And obviously, it's all assumptions, okay? And this is done by actuaries where they look at history. They look at the history of claims, they look at the industry, what's happening within the industry, and this is how they're able to then adjust, uh, you know, based on certain factors. They look at the cost of the insurance and then they will readjust. If they feel that, the policy is still fine, they give you another 5 years guaranteed. If they feel that, listen, we need to adjust the premiums because of XYZ, they do tell you 2 months before. So here we will notify you in writing at least 2 months before the adjustment. And then you will be able to assess and say, okay, cool, you can increase the premium and keep my cover the same because you have justified why the premiums need to increase. Or you can say, no, I cannot afford an increase in premium. What happens is they will then have to reduce the cover amount of the benefits proportionately. So if they feel that your premium needs to go up by another 5% and you say no, they will need to reduce your benefits by 5% because they're in a position where they feel like what you're paying doesn't justify the cover that you have because of certain circumstances and assessments and assumptions that they've taken into account. Okay, so that's what all that means. And this is in your contract, guys. So when the insurance company comes and says, listen, we got to increase your premium because of XYZ, because we've had a pandemic, because we've had high claims, because we've had XYZ, we need to increase your premium, then they have a right to do that because they have told you already. An insurance company is in the process, is in the business of making a profit, and also raising enough funds to pay out claims when the time comes. Then we'll look at provisions and assumptions. Basically, this is where you get further information about this. It says here taxability of plan benefits. Here it just says that under current legislation, the payments for insurance policies don't qualify for tax relief. All right, you don't get a tax break from this. The plan benefits will however be tax free in your hands, or in the case of a death benefit, in the hands of your beneficiary or your estate. Basically, this means that any amount being paid out to yourself or the beneficiary will be tax free. Okay, amounts paid out to yourself will be with regards to your critical illness or disability benefits. Remember, those pay out while you're alive if there is a claim event. Alternatively, the death benefit will pay out on your demise and will be paid out either to your beneficiaries, but also tax-free in the hands of the beneficiaries, or it will be paid out to your estate. However, keep in mind that if this cover is used for estate planning, then the benefit will be subject to estate duty, which you can't get out of. All right. So basically, this is the contract. Acceptance of this application subject to medicals. The contract consists of the quotation, your application plan, declaration form, our acceptance of your application, the contract documents and other documents, correspondence and information, if any, that by implication form parts of the contract. So they're just telling you what forms part of the contract. FYI, this quote forms part of the contract if you sign it and agree to it. So this quotation is based on personal details of the life assured. Then this is where you find your commission for the broker. Okay, so commission will be 5,000, will be paid in the first year upfront. In the second year, it will be 1,900, and then commission is usually paid yearly in advance. Commission on each future payment increase will be similar proportionately in proportion of the increase in payment, reducing with the outstanding term. Just one thing I want to touch on commission. If you take out a policy with a financial advisor, and let's say within the first year you cancel your policy because either life circumstances life circumstances you can't control, and the fact that you can't afford it anymore, and you cancel the policy, the broker will be required to pay back the funds that were paid to him by the insurance company, and yeah, the upfront commission he will it's called a clawback. So he'll have a clawback on this policy. So that's why in most times you'll find that brokers say, listen, let's try and see where we can help you. Please don't cancel this policy, because they know that there will be a clawback, and it's not good for the advisor because he has to pay back this money, and in most times he's already spent the money. Okay. And then there's also recurring commission. Um, and then if future cover option is exercised, for a benefit taken out when a future cover option has been exercised, we will admit a claim only if the claim event occurs, or the description and requirements of a claim event were first met while the cover for the new benefit was in force. This is if future cover option is exercised, that will apply. Then if you have group cover, or conversion option is exercised, you can, remember I said in my terminology, you can actually convert group cover. If you have cover with your company, and they do in most times give an option to convert it to a policy that you can keep once you've left your employment, or once you have probably resigned or retired. If you want to keep that life cover portion or the disability or whatever it is you were covered for, you can do it because of the conversion option. Okay. And then, yeah, so guys, in my next video, we are going to discuss the exclusions, and we're going to discuss free cover, and we're going to discuss the rest of the benefits, basically showing you what applies under death, what applies under comprehensive illness, and the categories and how they are actually categorized. So we're going to go through all of this in our next video, and we will leave this video here. As I said, that the videos will be in probably 4 parts, so that we get all the information and you guys understand all the information. So it's quite a lot to get through, and obviously with me, I am very pedantic in explaining everything to you guys. So catch me in the next video where we continue with part 3, and in part 3 we will discuss the exclusions and all the other interesting details that you find in the quote, which also are included in your contract. All right. So I hope you learned something new today. Thank you so much for joining me. I'll see you in the next video. Thank you guys. Take care and God bless.